Okay, let's take a look at how the markets are looking mid-morning on Bay Street and on Wall Street. You can see the TSX is off. Had a good start to the week, but right now it's ending on a poor note, down 375 points. Moving over to Wall Street and taking a look at the overall numbers. Let's see how they are looking right now. We'll go back to some of the movers on the TSX in a second, but just at the U.S. markets quickly. You can see the S&P 500 is up 5 points, almost 6 points, and the Dow Jones up 140 now. It's having a little bit of a rally. It looked like it was going to be a down day south of the border. The NASDAQ, though, is off by 30 points, but it's been improving as well. And, of course, let's take a look at what's moving, what's not moving right now. Gold stocks are under pressure. The price on them pulling back after soaring to record highs. We saw gold hit $4,331 yesterday, and that was driving everything up. But right now, when you look at places like Agnico and other mines, they are down today, taking a hit with the gold and concerns about what is happening there. Now, on the other side, let's go to Linamar and take a look at how Linamar is doing. And you can see it is up right now, and that's in response to the word that Trump may back off on the tariffs. Bloomberg News reporting the White House ready to ease tariffs when it comes to the U.S. auto industry and parts coming into it. The report says that as soon as today, the Commerce Department will announce a 5-year extension for an arrangement that allows automakers to reduce what they pay in tariffs on imported car parts. And Linamar is a major supplier of auto parts to U.S.-based manufacturers. And Canaccord also seeing a nice little surge. Look at that. It's up almost 16% right now. That follows on a report from Reuters that the financial services company is in early talks to sell off its British wealth unit. So we'll see what happens with that. Now let's get back to gold. It's been pulling back today. It had been soaring to record highs amid fears about credit quality in the U.S., the economy, and heightened conflicts between Washington and Beijing. Now that strengthened demand for the havens, but for more on this right now, it's having a slower day today after hitting that high. I'm joined by Thomas Winmill, Portfolio Manager at Midas Discovery Fund. And thank you very much, Thomas, for joining us.
It's a pleasure being here, even though the gold price is down. We've had a pretty good year.
It hit a record high yesterday, and it's off now. What's putting that pressure on it right now?
Well, I just think that there's a perception that gold is kind of a risk on asset. And, it's the old dichotomy. Is gold the candy mint or the breath mint? So either it's a commodity or it's an alternative currency. And I think right now the information looks like the market sees it as a commodity like steel or iron, that kind of thing, nickel. And it's losing its alternative currency boost that it got so far this year when it's been up about 55% so far.
And how do you feel? What do you feel it is?
Well, I think the short-term factors and some medium-term factors would suggest, it is a commodity. There's a lot of production going on, a lot of mines being put into production. Diwali's over and so forth. That jewelry demand is probably tapering off. That's a very elastic type of demand. But we think the longer-term factors that have led to gold to this historic level are going to continue. The main things that we see are the interest rates in the United States probably coming down as the economic figures show that employment's probably getting weaker, inflation's ticking up. But we think the most important factor are those big, almost unsolvable issues of U.S. government deficit spending and the unimaginable amount of public debt. So the debt ceiling, was adjusted to $41 trillion with an economy of the U.S. somewhere between $30 and $31 trillion. Those numbers just don't work out. It's what happened to Greece. So typically, historically, over the last 3,000 years, that gold has been used as a store of value, a medium of exchange. The first thing a government does is invoke massive inflation to bring down the actual nominal, the real value of those debts. Then you see taxation going up. Then you'll see maybe renegotiation of entitlement benefits. But the first thing that happens typically is a massive inflation. And lower interest rates usually lead to a weaker dollar. A weaker dollar means more dollars it takes to buy an ounce of gold. And we think that trend is in place. And until they can stop deficit spending, until they can actually reduce public debt, I think the trend for gold is solidly in place. It's going to go higher from here.
And how long are you looking at that trend for you? Is it a quick in and out with it, or is it something you want to hold on a little longer?
Trading gold for the short term is a tough business. These short term factors come and go. It's a very psychological type of holding. The market goes up, the market goes down. Today it's down, 4 or 5. The gold stocks are down 5, 6%. But over the last 20 years, I've been managing Midas Discovery. It pays to hold. So, over the last 3 years, we're up about 55% per year. And that's because these companies in the gold mine sector, the good ones that have working mines with low operating costs, they're making so much free cash flow. And that's going to eventually, it's the old weighing machine. That's going to eventually make these gold mining companies, stocks, a lot more valuable.
And how should people be thinking about putting their money, putting their money into gold and into gold stocks?
Well, it's hard to do, but the time to do it is when prices are lower, like today. You don't want to do it when prices are higher. An easy way for most people to get started is to do like $1,000 a month or $100 a month into a good, we think, mutual fund, because it gives you instant diversification within the sector and so forth. It's hard. Stay away from companies that are in big CapEx cycles, meaning they have to invest a lot to get an old, tired mine going again. Let's stick with the winners, ones that are currently producing gold and enjoying this amazing period of free cash flow.
And what are some of those right now that are looking good to you?
Well, the ones that we like are in politically safe jurisdictions. I think our biggest holding is Agnico Eagle, an old friend that's been around for years and years. It's paid a dividend every year for 45 years. Most of their mines are in North America, primarily Canada. There's some in Mexico and Scandinavia, very well operated. Even when they're making so much free cash flow, their focus is on lowering costs. They're a real company with very good management styles and teams and methods. That's probably the best one in the sector, we think.
They're having a little bit of a down day right now with everything that's going on, but not all that surprising. What about gold itself? Holding on to gold, what's the best way to approach that? Do you go with bars? Do you go with coins? How do you approach it for people?
It's a difficult situation because there are a number of factors that militate against really any kind of value in gold. First, there's storage, missed opportunity costs. Gold has the kind of intrinsic negative return on equity because of the cost of just holding it. And when you go to buy and sell it on the smaller retail level, say less than $100,000, the spreads are just really going to eat you alive. So for an institution that can minimize spreads, has a very low cost of holding gold, that's possible. We think the way to really get the most bang for the buck out, if you want just gold, is to buy a mining company, because it has gold. They're just in the ground. And, Warren Buffett talks about a gold mining company takes gold out of the ground and puts it in a vault under the ground somewhere else. But so for most investors, I would suggest that they avoid bullion coins because of the spreads and the holding costs, and focus on the stocks because of the inherent return on equity.
Okay, maybe a couple of gold bars under the mattress. Thomas, thank you very much for joining us today.
You're welcome.
Thomas Winmill is a portfolio manager at Midas Discovery Fund.